Are the financials still one of the sectors that you think could outperform in the coming months like they have over the last 6?
Thank you. Yes, we do expect financials to continue to outperform. That's a consequence of an improving economy and greater amounts of economic activity. So financials make money both from the spread between short-term and medium-term interest rates in their loans, but they also benefit from increased loan demand. And we will continue to expect this as one of the more cyclical sectors to do well as the economy continues to improve.
Jeff, with that in mind, are you as constructive on those financials? We've seen the interest rate picture get incrementally better over the last several months for the banks. We've also seen a pickup in capital markets activity, not just on the M&A side of things, but also on the trading and whatnot side of things. Is that going to be enough to carry this financial trade into the future?
Well, Domino, I don't know if I share the same enthusiasm that Cheryl does about the financial sector. Certainly, we saw a big move higher in the financials, but let's remember in 2020, financials were the second worst sector. So certainly when you look at a broad swath ETF exposure like XLF, you're seeing it up over 20% year to date. But I get a little bit concerned here as I believe, and I'm in the camp that you're going to see the 10-year note drift back to 1.5%, and that will kind of cool the bank's earnings. So I do see the banks and financials in the top 10 of our sector rotation technical matrix, but nonetheless, it's number 10. It's not number 1 like technology, software, and semiconductors are.
If that's the case, Cheryl, I'd like to kind of keep it focused here. You're going to watch what's going to happen with J.P. Morgan Chase, Goldman Sachs, and Wells Fargo report. What is it that they have to say to convince investors that the party still goes on for those big banks? And what is it that investors will perhaps say it's not enough in order for me to say, hey, there's been a 50 to 70% run over 6 months. Maybe now is the time for me to take profits?
I think what we need to see is a continued strong interest by those large organizations in keeping risk under control. So one of the major risks to this would be another Archegos or another large whale in the system such as that could lead to a great deal of losses. So we want to see continued strong risk control. We want to see them really paying attention to the communities that they are invested in. So we do prefer regional banks to some of the larger money centers. And we think that strong involvement in community and strong growth with the community will continue to be positive for banks and regionals.
All right. So constructive for banks, especially the regionals there. Jeff, if you look at the picture overall, you mentioned that you're not as high on some of these financial type stories out there. But are there ones in particular during this earnings season that you will kind of keep a focus on just to give you perhaps a sense as a trader about whether or not the market can still remain constructive?
Well, Dom, I think you can put a pep in the step of the banks if you see any type of rhetoric about buybacks. That's a magical word, buybacks. We love hearing that. And if we do see Jamie Dimon from J.P. Morgan, if we do see Bank of America, we see any of these big banks talk about buybacks, that will propel financials back into a position of strength. So I'm not casting financials away by any means, but I think this move in the last 6 months is by and large due to the fact that Cheryl brought up the NIM, the net interest on margin. That's really driven these stock prices higher on these individual names. But I do like financial services. IYG is an ETF that kind of tucks in MasterCard and Visa in conjunction with JP Morgan, Bank of America, and Wells Fargo. So if you look at those top 5 names in that IYG ETF, that's about 40% representation. And we're really excited to hear from JP Morgan kind of set the tone for the earnings season.
Cheryl, in your role as a portfolio manager, you're looking for the most effective way to deploy that capital. You're looking for the best returns out there. What do you think the macroeconomic backdrop is that we're operating in here in the U.S. and by proxy maybe around the world? What does that tell you about where the best investments will be in the coming, say, 6 to 12 months?
Thank you. Our macroeconomic outlook is very, very constructive. We think that the reopening trade is going to be very important, but we want to focus on companies that have cyclical exposure, but not the most extreme cyclical exposure. We are staying away from a expectation of high inflation. We anticipate that we will see supply chain disruptions. We'll see some spikes in prices, but we are looking for companies that have exposure to the consumer economy. We're looking for companies that have exposure to infrastructure in particular. We're looking for companies that are going to benefit from moving and transitioning to a lower carbon economy. So we're looking at companies that have exposure to hydrogen gas. We're looking for companies that will be will be building an infrastructure for electric vehicles across the country. So instead of very traditional, aggregates and commodities only, we're going to be looking for companies that are going to be participating in this restructuring of an economy to a lower carbon economy for the future.
Jeff, I mean, Cheryl brings up a very interesting word. That is infrastructure. It's probably the biggest word that we hear in markets around the beginning of any presidential term out there. It's talked about quite often. Does infrastructure and the expansion of perhaps some of those types of projects in the U.S. lend itself fundamentally to any kinds of trades or companies that you're looking at? The expectation that we could spend possibly, hypothetically, trillions of dollars on building bridges, roads, and tunnels, and maybe internet infrastructure out there?
Absolutely, and I think we get excited about that. Could be the catalyst to move the economy as well as the stock market even higher. So we talk about essential names. You hear me talk a lot about the essential names. These are tangible names. So talk about a Lockheed Martin, talk about a Boeing, talk about even some of the forgotten names like a 3M or a Waste Management. Those are all essential names that should participate in this move higher when we do see a big and bountiful infrastructure package come through the marketplace. So I get excited about owning those names, but think about some of those names that kind of forgotten about. I'm not walking away from the FANG stocks by any means, but I think you do have to be diversified, and that's going to make the difference in Q2.
Shepard Smith here. Thanks for watching CNBC on YouTube.